Good afternoon, everybody. I do appreciate you coming to this last session of the day before the big party of the week. The good news is that one of you will be going home with a new car. The bad news is it's Nick's car and it's in London. What we'd like to do is to have you walk away from this session with a pretty good grasp of open banking. And I think of open banking as the sum of really three parts, kind of the technical elements that many of you heard about earlier in Torsten's talk, kind of the business elements, particularly for North American audiences you heard in Don Cardinal's talk just previous to this, and some of the legal elements. While I don't think we have a lawyer on the panel, we will be mindful of how the regulatory piece is really shaping this phenomenon of open banking. If you remember Andre Durant's keynote, he talked about the next phase or the disruptors of the identity ecosystem. And our working hypothesis for this conversation is that open banking is going to be that kind of a disruptor to the open identity ecosystem. It's really the clash of these two distinct systems are now coming together through this phenomenon of open banking, and its roots fundamentally in providing customers, consumers, citizens more choice about how their data is used, and particularly in this context, how it's used in all parts of our economic life. So I wanted to start with a question to Chris Michael, because Chris has been talking to a number of global banks, particularly UK banks. And I'll first ask Chris the question, and then he can answer the question and also share a bit about his job at the Open Banking Implementation Entity. So Chris, from your perspective, both working for the Open Banking Implementation Entity and also building your own company, you've mentioned that you're beginning to detect a shift between particularly major banks who originally saw PSD2 and open banking as another regulatory burden. And now their banks and other FIs are looking at it in a different light.
Yeah, I think that's it's definitely a shift that we've seen in the last, I would say, 6 months or so. So when we started working on the open banking standard in the UK 2.5 years ago, I think at that time most of the banks didn't really want to do it. They were doing it because they were being told to do it by the regulator. And so it was a kind of damage limitation exercise. It was very difficult to get them involved and engaged in the process. And to be fair to them, actually, the regulations weren't particularly clear. So most of the hard work was about trying to agree what was a regulatory requirement. And in the standard, one thing that we did is we tried to make sure that the standard wasn't a limiting factor. So there was a lot of stuff in the standard that was optional. And we tried to do the right thing. We tried to build a standard that was optional, had optionality, flexibility in it, because there was a lack of clarity about what the regulations were, or what the regulations required. And what we certainly knew is that what the market wanted was more than the regulations required. So the fintechs, the third parties, wanted more functionality, access to more data than the regulations required the banks to provide. And that's what's happened, is that the banks have struggled to implement open banking in the UK, or initially struggled quite a lot. They found it a lot harder than they thought it was going to be. And so they spent a lot more money and a lot more effort building something, and they didn't do a very good job. And the customer experience wasn't great. The quality of the APIs wasn't great to start with. What's happened since then is a number of things. First of all, the regulations have got a bit clearer, and particularly in the UK, the regulators have been a lot tougher about the customer experience, making sure that when customers are redirected, they don't get lost and there's not unnecessary screens and steps in the way, and particularly enabling or requiring banks to make biometric authentication available for a third-party driven journey, because that's available to most customers. In the UK, I think around about 80% of customers now bank online using a mobile app with biometrics to authenticate. So that should be available if they're authenticating on their device for a open banking journey. So that's been a real struggle for the banks. They've found it harder to do this. It's taken them a lot longer. It's cost them a lot more money. And they've actually been forced to do it properly. Now, what's happened is they've now looked at this and said, well, we've had to invest all this money. Maybe we do need to make it work and think of it as a channel that's a revenue generating channel. I think what's also happened is most of the banks have also decided, because they've got the regulatory or authorization to also be a third party themselves, most of the banks are offering third party services themselves. So if you bank with Lloyds, you can connect to your Barclays account and you can get your Barclays transactions in your Lloyds app. So all of the banks are becoming third parties as well. And they're starting to kind of eat each other's dog food, so to speak. But what's really interesting, and I'll use this one example, is HSBC said this at a seminar a few weeks ago, is that HSBC previously have not been able to, or up until recently, have not been able to offer loans to customers who didn't bank with them because it was too risky, they didn't know enough about the customer. HSBC decided that they wanted to start offering loans to customers that didn't bank with them, and open banking was an opportunity to do that. But they worked out it would cost them tens of millions of pounds, take them about 3 years to do that themselves. So they've actually partnered with a fintech to offer that service, and it took them less than 6 months and cost them less than £1 million to offer that service. And they can now offer loans to customers who bank with someone else because of open banking APIs. And so that narrative has shifted, that the banks now are looking at open banking as an opportunity, a commercial opportunity, and they're looking at fintechs as partners, not competitors. And for the fintechs, it's a win-win situation because the fintechs, smaller fintechs, are trying to get established in the market. They don't typically have customers at volume. The banks have got customers and they've got a very strong brand, but they don't have the ability to use technology as well as the fintech. So I think it's a really good partnership that we're starting, or a number of partnerships that we're starting to see, and it's a win-win situation. The fintechs win because they can partner with the banks to get customers quickly at scale. The banks win because they can offer new services for much less money than they would previously be able to offer. And the customers win because they get really exciting new services that offer real value. And that's kind of what it's in the last 6 months that we've started to really see this take off.
It's interesting to me because the open banking implementation entity that you lead the technology effort on really was created in response to regulatory pressure. If I could get the British right, it's the regulators saying to the 9 largest banks, if you don't sort this out, we'll do it for you. And that was sufficient incentive to organize OBI?
Yes, and I think if the regulatory driver hadn't been there to start with, then inside the banks, they wouldn't have got the investment, they wouldn't have got the business case to actually invest in APIs. So it was good that that happened. The question is, in other markets, is that enough of a driver that, for example, in the US, can banks see the writing on the wall that if they don't actually get together and start offering these services, that at some stage maybe the regulators are going to come and make them do it. And that's, you're seeing that sort of interesting sort of discussion happening in lots of other markets all over the world now. And that's the question, I suppose, for any bank in any market is, do the regulators need to do anything at all? Do they need to mandate a little bit of something, or do they need to be quite strict and mandate everything? And I think it varies depending on the market, depending on the bank maybe.
Don, tell us about kind of the flip side in the US to what Chris has described as the UK experience.
Sure. Right now, we have, through FDX, we have a voluntary consortium. So the industry's gotten together. So the FIs, as I say, banks, brokerages, insurance companies, the data aggregators, permission parties, for example, credit bureaus, loan guarantors like Fannie Mae, as well as the fintech firms have all come together to work on a joint standard. They realized it's in their own best interest for a variety of reasons, but there's economics and business case drivers for it. If you're an aggregator and you want to talk to the 13,000 FIs in North America, you have to have 13,000 variants of your crawler. That's a lot of manpower to care and feed, because banks are notorious for rearranging the furniture on the screen and breaking your feed, which you lose access to your raw material. Can you imagine if you were a factory and your raw material is constantly being spotty? So by having it uniform, it reduces their cost. It gives them higher quality data. And I'll give you an example in the US that's very competitive. But when you say, what's my balance on my credit card? Well, you're going to get a Java developer to answer that question. Is it your statement balance, your current balance, your promotional balance, your cash advance balance? And if you answer with the wrong one, the credit grantor is going to make the wrong decision. Oh, you're maxed out. Sorry, no credit for you. When indeed they should have given you the other one. So by having that uniform metadata and agreeing on it, you get better data. So from a bank side, it's a huge cost savings in that they're serving up millions, if not billions of sessions a year to aggregators and fintechs. And that's a lot of hardware, a lot of personnel to support that hardware. APIs are an order of magnitude more efficient, so they can bend their cost curve down, and it's a low margin business. And by giving specific data permissions, the privacy aspect is also smaller. So there's less risk with held away credentials, less hardware cost, more privacy. It's a win for the banks from a bottom line and reputational standpoint. It's a win for the fintechs. Different purpose, but they're achieving the same goal.
Nick, Experian has a foot in the US and certainly in the UK. Mm-hmm. What the heck are you doing here?
So, me personally, on two hats.
No, we'll take you, we'll take them both.
Take them both, yeah. So I wear two hats. So I work for Experian, as the title says on the screen there. So in that capacity, I'm Director of Identity and Fraud Solutions. But Experian, you know us best for being a credit reference agency. And we do a lot of direct-to-consumer work in that, in terms of allowing consumers to understand their credit file. And open banking in that respect is going to be quite transformational for us and other credit reference agencies, because we're going to be able to go from looking at someone's past payment history around their credit to also including information about how they manage their other finances, both in terms of what goes on in their current account. So the first phase of open banking is really about releasing current and other accounts that the individual has with their retail bank. So that gives us a lot more insight into the individual and their behaviour, and we will then blend that with the credit score, and we'll have a much better insight into whether that person is a good credit risk or a poor credit risk. We'll also enable people in the US already. We're doing this score boost, so we're enabling people then to manage to bring all that into one place, see what their score is, look at the data, look at the way we are categorising the data, and maybe telling us we've got it slightly wrong, and improving that so that they can help manage their own finances in a better way. So we're an AISP in the UK, we're a TPP. We're going to be bringing out a number of direct-to-consumer products around that. We've also invested in a couple of fintechs. We've invested and then bought a couple of fintechs outright to enable us to deliver into this market, both in a D2C and a B2B perspective. We've also invested for the first time in a D2C financial services business, and that's a mortgage broker. And what we're doing there is bringing our data, the data from open banking in terms of getting statements together, the affordability assessment, and all of our technology into an online broker to try and create the best mortgage journey possible for consumers. It is a broker, there are people involved, and we've made that choice deliberately because the mortgage process is still very complex. You can move a lot of it online, but you still need a broker to help you through the journey. So we've made a very strategic investment there, and a lot of that is based on the availability of this data coming through. But beyond that, what we want to see for our customers and for the market generally is not just the data coming from the CMA9 and other banks who are doing it through PSD2, but from other financial institutions as well. So there's a project in the UK from the Tax Incentivised Savings Association as was, or the Savings and Investment Alliance, as they've now renamed themselves, starting to look at open asset management, as they call it, which is getting investment accounts shared in a similar ecosystem. So that I can not only look at what's happening with my retail bank, where I keep my day-to-day cash and day-to-day cash movements, I can also look at my investments, my stock portfolio, my lackluster savings accounts that I've got with a very poor interest, because they are a source of asset wealth. And then the other area is pensions. So we've been involved in something called the Pension Dashboard in the UK. We did the prototype for that 2 years ago. And that is now being moved forward by the Money and Pension Service, MAPS, in the UK, to enable pension data access and consolidation. So where this will all take us, it's probably going to take 2 or 3 years to get there, that I, as a UK citizen, can bring my banking through open banking into one place, my savings and assets from the investment community into one place, and my pension all into one financial dashboard. I have a total view of that. And then get advice and offers to maximise my wealth, or if I are in a different financial position, to try and manage my debt better and get me out of that position. So it's a real transformation for the industry, and just Experian, we're at the heart of that. The other hat I wear is I'm also chairman of the Open Identity Exchange. So we're doing a number of projects around interoperability, around leveraging data sources for identity verification. And one of the things we're looking at is how could you use an open banking logon as turned out through the open banking infrastructure as an identity proof point. Probably not on its own, but alongside other identity proof points to prove who the individual is, let's say for opening a credit account somewhere else or for log on to government. So that's something we're quite interested in, and we've been doing some work on that in terms of what value does that have in the overall standards for identity verification.
So let's talk more about standards. Chris and then Don, can you just give us the stack as you see it?
Yeah, sure. So, I mean, we've been working on in the UK on developing a common open standard for open banking. The first point is it's not our standard. It's been a standard that's been developed by the industry. We had to build a collaboration model. We've got about 2,000 individuals across about 500 different companies. So that's fintechs, banks, vendors, consultancies. It's a very sort of open collaboration model to develop this standard. But the other key thing is we wanted to make sure that this wasn't we didn't reinvent the wheel. And we took a decision fairly early on to work with OpenID Foundation to develop initially the FAPI profile as the kind of go-to gold standard for how we want to make sure these APIs are secured. The functional APIs are very specific to open banking PSD2 use cases, but along the way we've kind of collectively realized that, and the FAPI profile changed from being the financial API profile to the financial grade API profile because it just defines in a very nice way how to secure APIs for a number of different use cases, not just financial services. But I think the key thing is that both the security profile and the functional API specifications that we've developed, the key thing is that those standards, those profiles, are only as good as the implementation. And what we realized is that very early on that they were being implemented inconsistently. So we've also been working with OpenID Foundation to develop a conformance suite and a certification process off the back of that. And we've got a number of different conformance tools. We've got the one that the OpenID Foundation now sort of own and manage. Again, it's an open source conformance tool. We've got a functional conformance tool. Again, that's open source that helps banks test the functional APIs. All the request and response objects are all in line with the spec. And on top of that, we've also developed a set of customer experience guidelines, which break down how consent should be captured from a third-party point of view, how authentication should happen, what steps should or shouldn't happen. And previous session, we were talking a little bit about some of the kind of different approaches we've had in the UK around how many times you display consent to a customer, for example. And then lastly, we've got a set of operational guidelines where we talk about things like availability, performance, how to manage disputes and issues between banks and third parties. And all of those together form quite a sort of rich standard. So it's not just the technical specifications, it's all of those elements that are together part of the standard.
Don, can you do the counterpart?
Well, is quite right. It is a framework. And yes, you have a data specification. And yes, the FTX API is just one part of that, just like FAPI is one part of that. But we've also come to realize that APIs have been around for a number of years. And so our security framework is built upon the NIST framework, confidentiality, availability, and integrity. And through that, people have been securing data through mutual TLS and then incorporating things like end-to-end encryption. But we've also looked around the world at best in class. We wrote the spec we envisioned a redirect, we'd reuse the bank's authentication protocols as far as authenticating the customer and the response. So, for example, fully FIDO compliant and supported, also supporting other authentication mechanisms, the idea of risk and rule-based access, and token scopes. So it's embedded all throughout there, and you're spot on, Nick. We really wanted to incorporate that in an entire framework because there's no one part in isolation. You can't do one without the other. You can't have trust without security. You can't do security without good data hygiene. And none of us wanted to reinvent the wheel. So we picked a RESTful API, JSON request response, and really looked around the planet for what everyone else was doing.
As Chris said, a standard is only as good as its adoption. And its adoption really is a function of its interoperability. So one of the things that we've done at the OpenID Foundation, as Chris mentioned, is to create, along with the FAPI, the Financial Grade API Standard, a self-certification test suite. And self-certification sounds a bit like an oxymoron, but if you unpack what we've done is we've created a low overhead, high integrity certification suite that anyone at any time at no cost can take. So if you have an implementation of the FAPI standard, at any time you can go to OpenID Foundation's website and you can use that test as a way of understanding a QA, QC kind of a tool, understanding how close you are to conformance. Then at a time of your choosing, you can submit your deployment to this self-certification test. And it really requires two things. It requires you to publicly post the results of the test that you've taken. And that public posting does three things automatically. The first thing that happens is a peer review. Your competitors are likely to look very carefully at your test results to understand what they can about your deployment. The second thing it does, it makes your test results available to a worldwide review of developers, kind of in a crowdsourced way. The last thing that we ask you to do is that we ask a officer of your company to make a public statement that this set of results for this deployment is in fact true and representative of your company. So in that way, we've bound a legal self-attestation with crowdsourcing and peer review to provide the kind of integrity that we need from certification at a very low cost and easy to use way. So we think at the OpenID Foundation that both the standard itself, the financial grade API standard, and the self-certification test will fit the needs not only in the UK and the US, but elsewhere. So that certification piece I thought would be important to these kinds of deployments. Don, talk more about FDX's view of certification and how you see that evolving.
Sure. Remember, certification has several facets. The first is just the functional certification. Can you hit this spec, respond, and get a valid response back from a technical competency? But that's just one piece of it. Remember, if you've ever gone through a sourcing review at any other FI, there's a lot of other concerns besides just technically competence. It's what are your data processing, handling models? What are you as a going concern? Are you on any sanctioned nation list? That sort of stuff. There's a lot of other things that have to do with certification as well. So from a technical standpoint, yes, there's the self-certification, or you can do a PCI DSS And you basically say, hey, look, here are your approved testers, here's the approved script, you go out and get it certified, and they'll sign off, and they're carrying a lot of insurance behind you. And there's a lot of pros to that model as well, in that you're not picking a vendor, you're not picking one solution, you're free to go out in the market and shop it around. And two, it's a known model. People are used to PCI or SOC 2 type stuff. The actual audit of the entity itself, there's a lot of talk about how we do that as a commonality to get away from bilateral agreements and do that vetting one time. The UK solves that by having one firm blessed by the government, and there you go. We're trying to figure out how the market would best support that through a variety of mechanisms, through attestation, insurance, reinsurance, that sort of thing. So I think it's still working its way out because it is very organic, and so it's a little kludgy right now, but that's, I think the beauty of it is that the best idea will win.
Chris, certification in the UK is a bit challenging. Last I checked, you were still part of the EU. So can you talk a bit about the approach that you've taken to standards and certification and the impact of PSD2 on your thinking?
Yes, I think the first point is that we have to be very careful because under PSD2, it's the regulators in each country, in each market in Europe, who determine who can play in the ecosystem. So they authorize or don't authorize firms. That's both the banks and also the third parties. And they issue those authorizations. And there's a different criteria depending on whether you're an AISP or a PISP as to what you need to do to be authorized. So what we can't do is kind of contradict or undermine or gold plate that. So the certifications that we've been focusing on at the moment in the UK is really on the bank side of things. So making sure, and it's really on two areas, well, two main areas. So one is around the technical side of it. So that splits itself into two. There's the certification with the OpenID Foundation for the FAPI profile, and then there's a certification on the functional APIs for all the request response that I mentioned. And then we've got another type of certification which we've just started to look at, which is around customer experience, to make sure that banks haven't introduced unnecessary steps or done things in a way which confuses customers, and making sure they've followed particularly the requirements to allow customers to use biometric authentication. But we have to be a bit careful about where we kind of step into. I think the key issue that we're looking at now is that what the regulations require, I mentioned this earlier, it doesn't necessarily meet the needs of the market. So there's this kind of gap between what the market wants and what they're getting at the moment from a regulatory point of view. And that gap we're looking at, we call premium APIs. So there's a whole load of APIs that, or functionality, it could be just additional data in the same API, that's not a regulatory requirement. So the banks are not obliged to provide it, but there's a market need for it. So the banks want to provide it under some sort of commercial framework. And that's where I actually think we've got a lot to learn from some of the stuff that Don's been talking about over here, because we can't sort of enforce that from a regulatory point of view in the UK, but how do you govern that? And maybe there's a interesting space around sort of how you look at some of these other sort of certifications against, maybe it's other things like, liability models, for example. Under PSD2, the liability model is reasonably well defined, but when you start to provide things that go above and beyond, there might be additional liabilities there, and how do you kind of manage that in an ecosystem? And that's something we're still trying to work out as well.
Nick, the liability thing probably is a term that you hear a lot in experience strategy discussions. We're at an identity conference, you're an identity guy. How does that conversation play out inside of an Experian where open banking isn't directly part of your remit as a driver of identity, but increasingly it is?
Yeah, so in terms of leveraging open banking data as an AISP, the kind of liability models there is, in order to go back to certification, in order to become an AISP, there's quite a complex process in terms of provision of information, data policies, security policies that we've had to go through. and that that was oodles of information and quite a detailed process to go through to get on the list for an ASP. So it wasn't a simple self-certification. What I'm particularly interested in the kind of liability issue, linking into what Chris was saying around this premium API. So as an example, if a premium API is a bank enabling identity verification using an open banking identity, where if you log on with the open banking, it would also give out the name, address, date of birth of the individual, so we know who this is. Where does liability sit there in terms of, well, if the bank's got that wrong and someone else is now relying on that, say for AML purposes or as part of an AML check, where does the liability sit? And whereas AML is a particularly thorny issue because of the topic of reliance. So one financial institution cannot rely on the AML checks of another financial institution. So if one bank is relying on another bank's online banking ID for its AML checks, that's technically reliance. So the legals around that, there's a kind of clash between European regulation that's saying you should set an EIDAS certified or notified identity for AML purposes, and reliance, which says, well, actually, if that came from a bank and you're another bank, you can't rely on it. And those two things are at heads at the moment. Now, the UK banks aren't in that mix yet, but if they were to become identity providers under that model, that would be an issue that would prevent them relying on each other's IDs until that regulation is sorted. What none of that does actually is work out what the liability is. So there's an actual issue of reliance, which you're not allowed to do. The reliance rule says if you do rely on somebody, you cannot pass any liability to them anyway. You've still got to take your own liability from an AML perspective. Liability in identity is a thorny issue anyway, as you know, Don. So under the Verify scheme in the UK, for instance, when providing IDs to government, the liability indemnity clauses that the providers, as being one of them, have accepted are not very nice, and we'd probably never accept anything like that again as an identity provider. So any move towards banks being identity providers through premium APIs, the liability model needs very carefully thinking about. If that's going to be providing AML or data services, that's not money. So it's all very well being liable for a monetary loss, and you can really very easily scale and scope the monetary loss. If the loss is further down the line, and it's I've relied on this identity to do something that has now incurred not only a monetary loss, but a data loss and a personal loss for an individual, that's an entirely different sort of claim. It's not just money. It gets into GDPR claims, gets into a percentage of your global turnover claim.
I teach a course in identity at the University of Texas, and I talk about the holy trinity of identity: AML, KYC, and LEI, legal entity identity. How do you guys think about LEI? How do we know that that entity is who they claim to be?
Like any assertion of authenticity and identity, right? That there is a person named Don Cardinal. The person named Don Cardinal is a customer of a bank, and the person in this session is indeed Don Cardinal. There are a lot of assertions made around an identity, and you're only as good as the certifying authorities vetting and trust, because again, just like for a CA that gives out an EV cert, there's quite a bit of vetting that has to be done. But as we saw with Symantec, if you don't follow the rules, you break that trust model and you actually break that business.
Mm-hmm.
But you've got the registry, haven't you, in terms of...
I was just about to talk about the registry, and Chris, help me understand.
Yeah, sure.
Registry, directory.
Yes.
Okay, so I mean, the framework in Europe, and at the moment the UK is still in Europe, just about. So the framework in Europe is that firms who can participate in open banking have to be authorised, and the responsibility is with each regulator in each country in Europe to grant those authorisations and to publish on their website, on the regulator's website, a list of all authorised firms and their status. And that's, each regulator has to do that. Now, those are published in different formats, not available largely via APIs. So if you want to check a particular firm and whether they've got an authorization, whoever you are, whether you're Joe Public and you just want to check because you're not sure, or whether you're a bank, you want to check whether a third party has got an authorization. The only way you can do it at the moment, or up until now, the only way you could do it is you go to each regulator's website and check. But that's kind of checking the status. In terms of identity, what the framework that is being mandated across Europe is eIDAS certificates. So these are certificates that confirm the identity of a regulated firm, and they have to be issued by a qualified trust service provider. And so there are a number of those across Europe, and the qualified trust, there's a process between the qualified trust service provider and the regulator in terms of validating and granting that certificate. But those certificates are what are mandated to be used between third parties and banks when they are both establishing and a TLS channel for communication and for message signing. There are two different types. There's network certificates and signing certificates. So that process is mandated under PSD2. The eIDAS certificates are the method of identification between regulated parties, and the websites of each regulator are where you go to check the authorization status. So it's a bit of a mess. What we've done in the UK is we've created something called the directory, which is a central point where third parties can lodge their certificates, and where we provide in the UK a service to check the regulatory status on a daily, several times a day basis, and provide an API by which anyone can check the regulatory status and also validate that the certificate is still valid as well. So we provide a central trust point or trust anchor to help make things a lot smoother and more reliable and reduce risk for everyone. It also takes a lot of friction out because it's a directory, which means that third parties and banks can go there and via an API can discover each other as well. So it enables discoverability, it enables a higher level of trust in the ecosystem. That's something that's been going now for about a year and a half now. And it's a service that is not a mandated service outside of the UK, but it's certainly something that I think every market should have, because it really does help. And I think it certainly is something that it's not cheap to set up and provide that, but it's something that would add a lot of value in the States, I guess, in any market.
Don, do you have a similar project in mind?
We have one in mind. We've had a lot of discussions, and is it publicly available? Because there are a lot of things that would be useful in a directory, and I'm showing my age here, white pages, if you will, of firms. Remember, it's not just the aggregators and the data sources, but it's also the apps as well, because we want to see that chain, because God forbid there's ever an issue, being able to identify the link in the chain that has the issue helps you compartmentalize your risk and liability and that sort of thing. So the question is coming up with common identifiers, and then what data elements, because it's not just the legal entity ID as far as an index, but also what tokens you're authorized with, what audits you've passed, contact information, what are your IP and CEDA ranges for prod, test, and development, so that you can see that. Think about if you're defending the firewall at an FI, you start seeing some unusual traffic, either a known or unknown party. It'd be great to be able to go somewhere, look it up, and go, oh, that's so-and-so. They've probably made a mistake or brought up a new set of hardware that they didn't realize. You could reach out to them very quickly. So it has a lot of benefits having that central repository. The question is, which data elements, what's in there, and then if there's reliance on it, where does that risk? Because if you looked and said someone was certified, does it really mean they were? White pages is just a phone book and a phone number and address. So what do you really put in there, and what extent can you rely on it? What does that mean to the entity that hosts that list?
We talked earlier about the process of standards development, and people argue about period, comma, semicolon. Interesting thing happened during the work group where the financial API work group changed its name. And my head picked up and I go, wait a minute now. Why was the name changed? There was some agenda somewhere. And it turns out that Microsoft, one of the three leaders of the FAPI working group, convinced the working group that financial grade API would be a more appropriate name for this. The idea is simple, that as the FAPI standard profile gets more and more traction in the US and the UK on a global basis, other industries will go, well, if it's good enough for banking, it should be good enough for, Nick, what's your perspective on how this standard might evolve across sectors?
Yeah, I mean, you expect it as the first and as a high grade standard to be readily adopted. So when we're looking at something, I would go back to AML again. So looking at how do we now use digital identities for AML purposes. Within that, how do we do the technical exchange of that, but also how do we exchange the data? How do we exchange the proofs, the claims that go underneath that? And in terms of the kind of wrapper for all of that, then FAPI makes absolute sense. In terms of the payload, then that will be slightly different because we're going to be talking about verified claims, verified attributes, and there's another project that the OpenID Foundation is looking at around asserted attributes.
Assured attribute exchange.
Assured attribute exchange. So there's assured attributes you would expect to be, communicated readily under the same protocol. And I think it's keen to get moving on defining the content of those packages so that we can move on to other use cases. But so you've got that in terms of AML at a very simple level. You've got this now in the UK at a completely different area. So the UK has decided it's going to regulate its adult content industry online to stop young people seeing inappropriate content. There is a new standard that's been defined for that. It's been done largely separately at the moment because of the kind of slightly thorny area that they're working in. But equally, that API standard in terms of a secure way to create a tokenized authorization of, in this case, age, and all you need to know is age. Nothing else about the individual, just that they are old enough to see the content that is being proffered, could readily be delivered by the same protocol.
Mm-hmm.
I'd like to open it up to questions. I'm going to go get the mic and run the mic. So again, I ask you for the most provocative questions you can come up with at this time of the afternoon. Sir, I saw you nodding when we were talking about how this might move into other industry sectors. Do you have a comment or a question in that regard?
Possibly. So financial grade API standards, so the work that's going on perhaps in financial data exchange here in the US. Do you see prospects for open API initiatives affecting other sectors?
Absolutely. One of the parallels I like to use is we're a subset of the FSISAC, which, if you don't know, is a cybersecurity and financial fraud sharing association here in the United States, or worldwide, but the U.S. group. And they are, and they're widely acknowledged as being further ahead in the industry than the healthcare ISAC or the infrastructure or the transportation ISACs. Not because they wanted to, because they had to. They have trillions of dollars under management and custody, and they're being attacked constantly. So they had to be good at it. So again, anything that's good enough for the financial services, given the level of attacks, both through organized crime, advanced persistent threats, and good old-fashioned bad guys, it's been well-tested, crowdsourced tested, if you will, pretty thoroughly. So anything that's good enough for that, I think, has a lot of applicability. And I think, you've seen things like that migrate from one industry to the next as things are battle tested.
Earlier, you made reference to potentially banks becoming identity providers. One of the questions I had at that point is, what about regulation then on identity verification? And what happens when one bank is an identity provider for another, which results in a loss? Has there been any thoughts around that one, or even what thoughts you might have? I realize this one's coming out of left field.
Yeah, so there's been a fair amount of discussion on that. So the project we're looking at in AML in the UK, which again is run by the Savings and Investment Alliance, is looking at what happens when a identity is used to open a financial services account. And that could be an identity for someone like Experian, or it could be an identity from a bank. And one of the things that has been built into that, so we looked at the definitions, which are the snappily named JMLSG, Joint Money Laundering Steering Group, defines the way you do identity verification for KYC, anti-money laundering purposes. And the interpretation of that has been put together by a committee which involves Lloyds, HSBC, Nationwide, Barclays, ourselves on it, Fidelity, various other financial institutions. I've looked at this problem in terms of, is it wise to wholly rely on a bank identity for another party? Full stop. And the conclusion they've reached is it cannot be. So the standard that is being written, which is under the umbrella of JMLSG for the UK, is that if a bank became an identity provider, their ID alone would not be sufficient for someone else to accept it. They would have to add some other ID verification to their own ID that doesn't come from the bank, that comes from an independent, and so that could be verifying a document separately from what they did in terms of their own AML verification. It could be coming to a credit reference agency. It could be doing a selfie check against the document. It's got to be something they haven't done that's separate, that then gives that rounded picture that someone else will then rely on. The question then becomes around liability. So within that same project, we're looking at what would a liability model look like. We've got a legal firm looking at this, and the current thinking is that there will be a defined process that any identity provider, be it a bank or anyone else, will need to go through, that evidences the steps they've done to collect the evidence, two types of evidence generally, to do verification of the individual, that it is that individual, to do risk assessment around the identity risk associated with the individual, the end-to-end impersonation checks. How they did all of that must be documented, must be recorded, must be shareable as verified claims. So that when it goes from one organisation to another, there's a packet that goes and says, here's your two evidences, here's how it's verified, here's the evidence that there was no identity risk. And that is kept up to date and refreshed. If you can exchange that packet and you can evidence how you did that in your audit trail, and you will need to be certified as an identity provider, is the thinking, and audited. If you are doing everything correctly, then you would take no liability if it went wrong. If you've done something incorrectly, you will take the liability. Question, can you insure against that? That's where we've got to. Does that work as a liability regime, and is, in the event it goes wrong, is it insurable? So that project is exploring that at the moment.
Last call for questions. Mm-hmm. The other thing I teach my students in the University of Texas is, if you ever want to stop a conversation about identity cold, just say liability, and everybody stops. Last, I'll ask each of you to kind of give one piece of advice or one event or something that the audience should take away from as kind of the next thing that they should pay attention to in this open banking, open identity world. What is it that is going to be the next event or the next indicator of traction and change in this? What would you say the takeaways might be for our audience here?
I'll go first. Probably
Yeah.
a tricky one. From an experience perspective, what we're interested in is consumer adoption. So all of this so far is theory, really. The work's been done. There's lots of people become AISPs, TPPs rolling out there. There's no service yet that's really exploded in terms of mass consumer adoption. The nearest, I think, is the banks themselves adding other accounts in and collecting them together. What we've not seen yet is a really big take-off. And I think when that happens, things will snowball, because consumers need to get used to this concept of, I can take my data from over here and share it over here securely. Well, that is new for them. And I think we're waiting for the event where that really takes off.
Yeah, I think there will be a tipping point where we reach critical mass. You know, we're at 2 million here in the U.S., going to 6 million projected, probably faster than that. And you'll see, as things kind of go, you'll see this upward sloping curve, and you'll see an inflection point where pretty much everyone will jump on, because no one wants to be the last one still allowing scraping, still allowing held away credentials. So just like every other deal, the last person's providing Betamax, showing my age here, everyone wants to jump on. Once they see a standard going, Everyone wants to jump on that one, but everyone wants to wait to see what everyone else is doing. But there'll come that inflection point, and you'll know it when you see it.
Chris, you're an entrepreneur and leading a hot company called Ozone. What are you looking for from that point of view?
Well, I'm going to contradict Nick slightly. I think I'm going to be a little bit controversial. So I don't think the interesting thing here is data and data sharing. I think that's been around, admittedly, via screen scraping for many years. And I don't think the next big thing is going to just be more of that. I think those, there are many services out there, both from a business point of view, accounting packages, there are personal finance managers, those things exist, and they provide value. Open banking just makes them better. I think what I'm interested in is the payments and the combination of data with payments, because I think that's where it gets really interesting, where you can start to see payment APIs that offer a genuine alternative to cards and card schemes. And something that I'm very interested in, one of the reasons why I built my Ozone platform is because I want to help banks in this space. And I think the key to that isn't just redirect. Redirect for payments works well if you're buying something online. But if you want to buy something when you're in a store, that's when you need a decoupled experience where your consumption device, an EPOS terminal, for example, is different from the authentication device, which would be your mobile banking app. And how do you do that in a way that's secure? And we've been working with the OpenID Foundation on a CIBA profile that many of you have heard about before. I think that's about to be published as going out for voting as the first implementers draft, going out for voting for any day now. And that is something I think is really exciting. It's not a regulatory requirement anywhere yet, to my knowledge, but in that space of premium APIs, I think decoupled experiences to give consumers a new secure way of paying via their banking app in store, I think is really interesting. It'll save merchants, potentially bigger merchants, hundreds of millions of pounds a year. It provides something that's, I think, more secure than many of the card schemes and payment methods are out there at the moment. And it provides immediate settlement to merchants as well. So there are many, many benefits. The challenge is, can we make it as good as Apple Pay or nearly as good from a customer experience point of view? But I think that's where I'm really excited about and being part of that journey.
Thank you. My one takeaway for you is that tonight's party is going to be really great. It's at the museum, and I think the museum will be open to all of you, but do take an opportunity. It's kind of hard to find, but if you go out on the porch or the patio of the museum, you have just a glorious view of Washington, D.C., and that'll take you away from the rock and roll and just show you this beautiful city that I live in. Thank you all for your time and attention. How about a quick round of applause for these presenters?